What is inflation targeting, and why do central banks use it? Have you ever wondered how central banks keep the economy stable? One key strategy they use is inflation targeting. So, what exactly is inflation targeting, and why is it important? Inflation targeting is a monetary policy approach where a central bank sets a specific inflation rate as its goal. This target is often set for the medium term, typically around 2 to 3 years. The central bank then commits to achieving this target, using various tools to manage inflation. One of the primary tools in this strategy is adjusting interest rates. When inflation rises above the target, central banks may increase interest rates to cool down the economy. Conversely, if inflation falls below the target, they might lower interest rates to encourage spending and investment. The main aim here is to maintain price stability, which is essential for sustainable economic growth. Central banks favor inflation targeting because it helps stabilize public expectations about future inflation. When people know what to expect, it reduces uncertainty in the economy. This stability is crucial because high or unpredictable inflation can erode purchasing power and distort investment decisions. By focusing on price stability, central banks can also balance inflation control with other economic goals, such as smoothing out fluctuations in economic output. Now let's connect this to socialism and economic planning. In socialist systems, where central planning is more prevalent, the focus might shift from inflation targeting to direct control of prices and resource allocation. These systems prioritize meeting social needs rather than relying on interest rate adjustments. However, even in socialist economies with central banks, addressing inflation remains important. Protecting the real value of wages and social services is vital for maintaining public trust and economic stability. Inflation targeting, therefore, represents one method that central banks use to stabilize the economy. While it works well in market-oriented systems, critiques from socialist perspectives often highlight its limitations. These critiques point out that inflation targeting may not adequately address broader social and economic inequalities or the root causes of inflation linked to market dynamics. In summary, inflation targeting is a key strategy for central banks to manage inflation and maintain economic stability. It combines a clear numerical goal with the flexibility to respond to economic changes. Understanding this approach is essential for grasping how different economic systems, including socialism, navigate the challenges of inflation and economic planning.